back to this week's hashtag Finance Friday. And today we are digging deep into the detail of provisional tax, but not so much just the motion of provisional tax, but really as you're preparing your tax return, some of the detailed deductions that you can claim, because tax can be super confusing, so much so that sometimes we tend to just want to get it over and done with. But in doing this, we sometimes miss out on things that we don't even know about, or maybe we forget about, in terms of our tax deductions and tax benefits that might be available to us. What? Tax can be beneficial? No freaking way. But you're taking my hard-earned money. So yes, that's true. But you can also claim some money back. And money back is an exciting and sometimes one of the most relieving phrases that you can hear. So let's jump in and have a look. Tax benefits and tax deductions, two different components or two different definitions that we need to just look at here quickly. Firstly, the term tax benefit refers to a tax law that helps taxpayers reduce their tax liabilities. So it's something that's to your benefit, that increases how much you're allowed to claim. And secondly, a tax deduction is a deduction that lowers a person's or an organization's tax liability by lowering their taxable income. Okay, so the one reduces your tax liability, so like a rebate, and the other one will lower your taxable income. Okay. Now, there are many ways to save through tax deductions and some tax benefits. Let's have a look. I'm going to mention a couple and then just see where we go. Not all of these would necessarily be relevant to you, but it's helpful just to know what the options are that you can potentially look at. Firstly, medical expenses. Now, depending on the number of members that you have on your medical aid scheme, you could claim more credits or less. This only really applies to you in your personal capacity, not really business, but that's all good. You can also claim for out-of-pocket medical expenses, which applies to the portion of your medical expenses that has not been covered by your medical aid scheme. The medical scheme fees tax credits is a deduction to your tax liability or the amount that you owe to SARS, as opposed to reducing your taxable income. So that really helps to get you down to owing SARS less money, which is really awesome. Okay, and you don't, this is not impacted by the marginal tax rate. So it's not only, say, 20% or 40% of the tax that you're saving, it actually reduces your liability in total. Secondly, retirement funds. Now, if you are an employee and your employer is contributing towards your retirement fund, there may be a taxable fringe benefit that will arise in that instance, which means that actually you are paying tax on that. But you also benefit from it in that you are able to reduce your taxable income by a certain percentage based on your retirement fund. So let's have a look. If you're making contributions towards either a pension fund, a provident fund, or a retirement annuity, you can claim that as a deduction against your taxable income, as long as you're making contributions to the fund. So whether that's you contributing or whether it's your employer contributing, you can claim that. Now, if contributions made exceed certain limits, then those claims are carried forward to the subsequent year of assessment so that you can benefit from it in future. And that limitation, which not a lot of us would have got into in the ordinary course of running our lives, we're limited to either $350,000 or 27.5% of your income for the year. Okay, so this is really helpful just to keep in mind. So if ever you are wanting to get a bigger tax deduction, if you are worried that you're going to be paying too much at the end of the year, it's really helpful just to make a top up to your retirement annuity fund, because you know you are investing for the future, so that's perfect, but you're also getting the tax benefit today by reducing your taxable income. There are, however, obviously taxable implications when you withdraw that money. So lump sum benefits as a result of withdrawing from your membership of a retirement fund, including amounts assigned in divorce settlements in certain circumstances other than death, or your retirement lump sum benefits are taxed. And even when you are retiring and you are withdrawing some of that money, you may find that there are tax implications at that stage as well. So just always helpful to know, yes, you are getting some deductions now, but you may be taxed on it later. But the value of it today is going to be so much greater than in a couple of years' time. So rather take that benefit. Okay, third option, donations. If you donate to a public benefit organization, and it has to be a public benefit organization in terms of the Income Tax Act, you're able to claim that donation as a deduction against your taxable income. It is limited to 10% of your taxable income before that deduction. But all you need to do is provide that Section 18A certificate to prove to SARS that you have donated to a public benefit organization, and you're then able to claim that. So think about like animal welfare, so I donate to animal welfare and Doctors Without Borders, for example, and both of those have Section 18A certificates. So I know I'm making some monthly contributions, and at the end of the year, I can put that through as a deduction on my tax return. So it's a way for me to help other people while sort of helping myself at the same time, right? So that is really a cool one. Then the next one, number 4, is travel claims. So if you're using your car for work purposes, and if you can prove to SARS that a portion of your travel expenses are for work purposes, then you can claim a deduction on it as well. As long as you are keeping a logbook, okay, you have to prove where you have gone, which dates it was, how much you traveled, and it should be approved by your employer as well. In that instance, you may be able to claim against that travel cost. Now, there are 3 components of the rates that get taken into account. The first one is fixed costs, you've got fuel costs and maintenance costs. And those get, you can use those as you're determining the cost of business travel, in the instance that you're not using actual expenses. So if you don't have fuel slips, for example, and all of those types of things, and if you don't know how much it's actually costing you, then there is like an estimated rate that you're able to use. Do, however, also, again, bear in mind that if your company is contributing towards a travel allowance for you, that component is a fringe benefit and you will be taxed on that. So if you're receiving the allowance, try and make sure that you have a equal expense, effectively, that you can net that off against. Okay, so number 5, tax-free investments. Now, if you have invested in a tax-free investment account or a tax-free savings account, as it's commonly known, in those instances, interest income that you earn on that account is fully tax exempt, as opposed to with other investments where it's only exempt up to a certain point. But more than that, and this is potentially where more of the benefit comes in, is when you withdraw money from that tax-free investment, or if you cash in that tax-free investment, depending on how you want to look at it, the amount that you receive is also ignored for capital gains tax purposes. There are some limitations that you need to keep in mind, such as your annual limit of 30,000 that you're able to contribute and a total of 500,000 over your lifetime. But over and above that, it could potentially be a really good option to consider. Then number 6, severance benefits. Severance benefits are lump sums that are received by employees from employers when they are terminated. So think about retrenchments. So there are some benefits that you can get there that might not be fully taxable, but you would have to check the specific situation that you find yourself in. And then finally, disability. Now, disability for tax purposes means a moderate to severe limitation of any person's ability to function or perform daily activities. This limitation will only be regarded as a disability if it has lasted or has a prognosis of lasting more than a year, and it has been diagnosed by a duly registered medical practitioner that has been trained to diagnose the applicable disability or to express an opinion thereon. Okay, so in other words, long story short, you have to be disabled for more than a year, and it has to have been diagnosed by a professional medical person. Okay, short story. Now, if you or your spouse or a dependent like a child has a disability, you are entitled to claim certain qualifying medical expenses in the form of an additional medical expense credit, tax credit. So in other words, it's going to reduce that tax liability. Okay, so this will include expenditure that is prescribed by SARS and which is as a consequence of any physical impairment or disability. But the expense must be necessary for the alleviation of the restriction on that person's ability to perform their functions of daily living. So this could be if your child has a disability, if you're sending them to a special school, for example, that could qualify as a benefit, or that could qualify as a valid tax expense that you're able to claim. So if you, your spouse or your child has a disability, you can claim 33.3% of the qualifying out-of-pocket medical expenses, which includes your disability-related expenses paid by you and not recoverable from the medical aid, obviously, during your year of assessment, as well as 33.3% of the fees paid to a registered medical scheme or qualifying foreign fund, as it exceeds 3 times the amount of the medical scheme fees tax credit to which you are entitled. So you first have to spend 3 times as much as your tax credit is, and then after that you can claim an additional 33% of the out-of-pocket expenses. So this is actually quite a big benefit that you're able to get. So if this is you, if you are wondering if maybe you qualify for this benefit, then I would highly recommend that you get in touch with Anneke Olivier from Bendels Consulting, and they will be able to assist you with the calculations and with the submission of your tax returns. And they have a good track record of saving people lots of money as a result of this disability tax. So definitely check that one out if you feel like your family might qualify for that. Okay, so a lot of what I've just spoken about is more from a personal capacity. So let's just quickly have a look at capital allowances for corporates, because in your business, you do also qualify for certain benefits from tax. Okay, so corporates receive allowances on buildings for industrial use. So whether it's manufacturing, and it could be anything like 10% or 5%, 2%, or 5% for new and unused commercial buildings, okay, as well as your improvements. So buildings, anywhere from 5 to 10% usually. There's also a 5% allowance for costs incurred in acquiring, not developing or creating, inventions, patents, or copyrights, and 10% for designs. So that's quite cool. And capital allowances are also granted for plant and machinery. So those are like your assets that you're using every day that is used in manufacturing or similar process that will allow you to write it off faster. So it could be then written off over 3 years or 4 years potentially, as opposed to 5 or 10 years, depending on how long it's going to last. There are also additional incentives for people that are involved in renewable energy as well as farming industries. So really there's quite a lot that you can do here, but in these instances, make sure that you're consulting with a tax professional that can actually guide you correctly in terms of what can be done. And finally, as a small business corporation, you may or may not fall within this definition. There are also additional benefits that you can get in terms of reducing your tax burden. So I think we've done a discussion about that previously, so do check that video out where we go into a little bit more detail about small business corporations. Okay, so that's a lot of stuff that you can do to save on your tax. So the question now arises, once I've now gotten my money back, what do I spend it on? The short answer is don't spend it, invest it, right? Now, you could either invest your money back into your business, and that won't only increase your assets, but you will also have that money set aside in the case of emergency, okay? It's always a good one to keep in mind. And the same goes for your personal capacity. You know, if you're getting money back, rather go save it somewhere. It's bonus money that maybe you didn't budget for. And then secondly, another option is to invest in your community. So if you donate some of your spare money or money that you got back to specifically a public benefit organization, that will give you an additional tax benefit, right, on that. But if not a PBO, then check out what other community or charity-based organizations are in your area that you might like to support. I think that's always a good way, right, to give a little bit back from what you've been given. Or lastly, invest in your employees. Now, you can give them a bonus or organize a team building day or send them something nice on their birthdays. The options really are endless. But again, in this, you are investing in the future of your employees and investing in the future of your business in this way, while at the same time getting a tax benefit from that. So there are really a lot of ways that you can use your money that you're getting back from SARS, but just be wise about it and be clever and think about how can I use this to make sure that I'm getting another tax benefit later down the line. Okay, so that's it from me for today. And next week, we're going to be chatting to Kudzani Mtoveni from Pivotal Flow, and we're going to talk about, I don't know, all sorts of interesting things. So make sure you tune in next week to see what that's about. Okay, so I'll see you then. Bye.